everybody. Welcome to our next segment of Hugh Knows, where we are breaking down what is going on in the market and how it's impacting mortgage rates, and then more importantly for realtors, how that's impacting the real estate market, especially locally here in Houston. So if you haven't tuned in before, I'm Austin Baker, along with Jonathan Bunk.
What's up?
And Mr. Hugh Hartzog.
Hey.
Jonathan and I have no idea what's going on, but Hugh does, and that's why we call it Hugh Knows. So before we jump into the segment this morning, a couple of quick boilerplate things. We are
a DBA of network funding.
That's right.
So.
And everything we express on this episode is our own personal opinions and not necessarily the opinion or position of our parent company, Network Funding. And this is also being shot on a specific day and specific time. And so by the time you watch this, things could have changed. So just keep that in mind, that we're saying all of this stuff based on where things are today, which is February 20th, 2023.
President's Day.
President's Day. We love President's Day.
But yeah, let's go, baby.
Let's go. All
Make it
right.
happen.
So first out of the gate, we want to talk about what has changed from last time in regard to interest rates. Hugh, what happened in interest rates from, I think we dropped the last episode, end of January.
Yeah,
That's right. So interest rates have gone up a little bit, at least for mortgages. They've gone up a little bit, and we'll jump into that more deeply here in a second.
Yeah.
I mean, the crazy thing is they dropped to 5.99, and everybody and their mother was like, rates are dropping, rates are low. And then a few weeks later, we took off again.
Yeah, I don't think I've seen a single article yet. It's been 20 days.
No.
The interest rates have been rising, and so that's interesting. So this might be news to you, but interest rates are there. They've been climbing over the last 20 days since we dropped the last episode. So, Hugh, break it down. What changed? What were the big impactors for us over the last 20 days?
Right. So a couple of things that have happened since our last episode. One was that the Fed had its meeting. We've also seen the employment numbers for January come out. And we also had the CPI numbers for January come out. So had a couple of big major economic events, pieces of data come out, and the net result of those events is that we saw mortgage rates increase. So like Jonathan said, we'd seen the 30-year fixed mortgage rate go down as low as 5.99%, and that was right after the Fed met at the end of January, early February. And largely the market took the Fed meeting as positive news, and we saw rates fall down to the lowest that we'd seen in several months, going, like we said, down to 5.99%. But after that,
very short-lived.
After that, we saw a couple of other pieces of data come out. One was the labor report for January, and that labor report beat expectations. So we added more jobs in January than a lot of economists were expecting. And the result of that is that markets were, they took that as sort of negative news, which kind of sounds backwards because we're adding a lot of jobs, the market take it as negative news. But that's because obviously we've been seeing inflation, and one of the main drivers of inflation is the price you pay for labor. So if you see a tight labor market, that indicates that maybe there's some more inflation that's going to be seen in the numbers. And so markets took that as negative news, and we started to see interest rates increase since then. The CPI report did come out in February for January, and that actually saw at least the year-on-year number come down slightly versus December. But it didn't come down nearly as much as people were expecting.
Enough.
And so even though there's positive news insofar that inflation on a year-over-year basis seemed to continue to weaken or to come down, which is what we want to see, it's not coming down as quickly as the markets would like. So those are the big events. And if you're looking on the screen now, you'll see we're showing the 30-year fixed mortgage rate. You can see it peaked back in November and has come down, particularly as we saw inflation start to ease. We saw a couple of good inflation readings at the end of last year. But since the end of January, we've seen that 30-year fixed rate go back up for mortgages as a result of the data that we saw coming out.
Cool. So let's show them the slide, Hugh, where we're honing in on all that.
Right.
This to me, I think is always so interesting to talk with realtors and borrowers when we get these positive pieces of information. You know, it's like, we've added jobs. That's positive, right? Like, that seems good. Like,
it depends on your perspective.
Inflation numbers seem to be improving year over year still. That seems good. But break down, let's talk briefly, Jonathan. Why is that not good news?
Well, I mean, anything running too hot is bad, right? Your car runs too hot, boom, the engine blows up. So if the economy is running too hot, it'll break our system. It'll break our economic system. And so that's why unresolved or rampant inflation is terrible. And so the thing I've loved is that the Federal Reserve's putting the whole entire economy on a credit diet. That's why we have higher interest rates, higher mortgages, higher federal funds rate, all that stuff. And so it looks like they might have to do more to get things to where the engine is not running so hot in our country right now.
Right. And Hugh, you talk about the role that employment has, specifically when it comes to inflation. Draw that connection for us.
So on display now, I'm showing a couple of different things, but the chart on the bottom left, I'm showing the CPI and the PCE. So that's the Consumer Price Index and the Personal Consumption Expenditures Index. And these are two measures of inflation. Both measures of inflation are going to be impacted by employment. So let's just take the CPI, for instance. The CPI has specific components that make up the CPI that are specifically related to the job market or the labor market. So the labor market, how much you're paying for labor, that is, how much people are earning on their wages, that impacts on whether or not we see the CPI go up or the CPI go down. And of course, again, like I just said, the CPI is measuring inflation. And if you see labor costs going up, that's going to push up inflation. And so at the last Federal Reserve meeting, when they were discussing whether to raise interest rates for their federal funds rate, which is different than the mortgage interest rate, but they're related. The Federal Reserve Chairman Powell specifically focused on the labor market, saying, hey, look, we've seen a lot of inflation come down for things like commodities, whether you're talking about oil and gas or you're talking about food. We've seen prices of those sorts of things come down, but we haven't started to see wages start to come down or soften. And they're very concerned about that because, like I said, what you're paying for labor is a major component of how you calculate the CPI. And so if labor is continuing to rise, that's pushing up inflation. So that's why the Federal Reserve is focusing on the labor numbers, because they really want to see those come down to see inflation come lower. And then right after the Federal Reserve met, we had the labor numbers for January come out. So the Federal Reserve focused on the labor numbers, saying we would like to see labor numbers come down. And then the very next report that's released shows the labor market's really strong still.
Yeah, and even stronger than expected.
And stronger than it's expected. So if you're looking at the slide on display, the chart on the right, I have an orange box around the very last labor reading, and it was much higher than the previous months. We added 517,000 jobs in the month of January, which was more than double what most economists were expecting us to add. And you can see versus the previous several months, a much higher increase.
That's a huge pop.
Yeah, almost double what we were seeing, for instance, in the December numbers. So
yeah. One of my arguments has been everybody's saying Google, Apple, all these tech companies laying off people who are making $200,000, $300,000, $400,000 a year, and then Uber, who just had their Q4 numbers, has tons of free cash flow, tons of revenue, lots of new drivers added. So I'm like, how many of these tech people getting laid off are now driving DoorDash or Lyft or Uber? And now the labor statistics department's like, new job added. And so I think wage growth is the most important thing, and I think it's really hard to measure. And I think the market just kind of went schizophrenic when they saw so many new jobs added, but it takes a lot of time to digest this data. I think it's a little bit of an overreaction.
Yeah. Right.
And so hopefully we'll see a short-term correction after what we've experienced the last couple of weeks. But
yeah. And just to wrap up this segment, when we're looking at what the Fed's trying to do, the Fed is not worried about a recession. They are worried about runaway inflation. Mm-hmm. And that's the message I feel like I keep reminding all of our realtors that we're talking to, is like, everyone's like, why is the Fed doing this? And it's like, we can get into the weeds on.
Because we don't want to become Venezuela.
Yeah. Were they too slow in starting the rate hikes? Should they have done them quicker? Should they have done other things along with it? But the reality of it is, yeah, we can analyze what the Fed's done, but they do not want to have runaway inflation. We can't become Venezuela. Like, we've got to keep the economy in check. And so that's going to mean we've got to take some short-term pain for long-term gain, right? And so, but that's that macroeconomic outlook in a nutshell.
Yep. Now we can move on to the next segment, which is the U.S. real estate and mortgage overview.
Dun, dun, dun.
That's where we live. Let's go.
Here we go.
So, the slide on display right here, it's showing two data series. One is mortgage application volume, and it's on an index, and so that's going to be the gray area, and then the orange line shows the 30-year fixed mortgage rate. So, basically here, the main point is, as we see that orange line really start to rise, really in the middle of last year, we see mortgage applications decline.
I think high rates discourage people from wanting to buy real estate.
I think that's the takeaway. So
Shocker.
You see that gray area start to go down pretty substantially as you see that mortgage rate and the orange line start to rise. Now, the good thing that I want to point out, and it's kind of hard to see, but on the very right-hand side of the chart, you can see the gray area is starting to tick back up. And we'll show you some of this data for our own branch, Monk & Baker Mortgage Group, later. But we have absolutely seen more applications since the beginning of the year versus what we were seeing in the Q4 of last year. So definitely some positive news as regarding to that. Absolutely. And then on the next slide, this is an interesting chart. So this is all historical data going back to 2005. And what this is showing is the foreclosure rate, which is how many homes are foreclosed on versus how many how many mortgages there are. And of course, you can see back in 2008, 2009, we saw a huge increase because of the recession back at that point, when we were seeing 2% of mortgages getting foreclosed on. That's come down substantially. 2021 was one of the lowest years that we've seen on record as far as number of foreclosures. That did tick up slightly in 2022, but the good news for us is that it's still well below historical averages as far as the foreclosure rate. Now, you could see this as good or bad, but one of the things that we know as far as home prices is that, if you have low inventory, that supports prices. In order to see inventory really increase, what we need to see is foreclosures start to increase, because foreclosures will really start to drive inventory levels. And so what this is telling me, when I look at the data, looking at the recent past, is that foreclosures are down, and so we're unlikely to see inventory. Looking at the whole U.S., but we could apply this to Houston specifically, we're unlikely to see inventory jump, and so that is a case for seeing home prices supported.
Yeah, and so some quick perspective on everything. In 2020 and 2021, the government put a lot of mortgages in forbearance. So like, you couldn't foreclose on somebody who wasn't making their payments. And so literally that's why they had none. Right. And if you're looking in the news right now, it's like 80%, 90% foreclosures are up from last year. It's like, no duh. Like, look at the chart. They were at 0.1, now they're at 0.2. But you look back at 18 and 19, those are nice normal years. Right. We're well below that, where just a normal foreclosure rate is. Things are normal in 18 and 19, and we're not even nearly there, much less where things are falling in 2009, 2008, when things were bad. So it's like, we're not going to see any foreclosures, which means we're not going to really see a lot of inventory due to foreclosures.
Yeah, and I think that is because of a couple of things. One, the charts we were just looking at in the last segment showing where wage growth has been, where employment is. It's like, what causes foreclosure is people not being able to afford things. So mortgage is the last thing that people usually start to default on. And so where jobs are strong, and then you look at what happened to interest rates during COVID. Right, people's homes became even more affordable. So everyone that currently owns homes, their houses are now more affordable than they've ever been. And they're sitting on these historically low interest rates that we likely will never see again. And so then those people don't want to give that up. They're going to do everything they can to keep that. And so, I think it's a combo of all of that. The job market's strong. People are sitting on super low interest rates. And then because there's such little inventory, even if you were about to go into a forbearance situation, you could sell your house like that.
Right.
And so, yeah.
And you know, just to jump on this next slide, I'm showing a sort of leading indicators of a leading indicator of foreclosures. And so this is showing the percent of mortgage loans that are delinquent, and you break those down in the red, orange, and blue by delinquent by 30 to 60 days, and then the orange is in 90 days, and the red is they're already in foreclosure process. So we did see that jump at the beginning of COVID. Obviously, there was the eviction moratorium, so we didn't see nearly as many actual foreclosures. But we did see the number of people that were late as far as making payments jump during COVID, and that has come substantially down. And the good news is, if this is a leading indicator of foreclosures, is that even though we did see a slight uptick in the very last quarter of 2022, we're still way below where we've been even prior to the financial crisis and certainly prior to COVID. So again, indicating that foreclosures aren't, at least from a leading indicator perspective, likely to jump real high.
So if you're sitting on the fence thinking home values have come down, you are a fool.
Right.
That's how I feel.
It's unlikely to happen. Yeah.
At least not in the near term. There's a lot that has to happen. You can see how long it takes. I mean, it's an impressive chart. You know, when I look at it, it seems like just the 30 and 60 day lates, right? Those seem to hover historically around 4%. And we're just barely over 3%.
Right.
You know, I mean, that's 25% below where it seems like the historical averages for that data piece. And it's like, that's got to be increasing, you know, and then you've got to be seeing an increase in the 90 days. And then, of course, the foreclosure process, it's like none of that is really, you know, drastically increasing, at least not at the moment.
Right. Yep. So anyway, that's basically it for the overview of the U.S. mortgage and real estate segment. So with that, we'll jump into the next segment, which is Houston Area Economic Analysis.
H-Town.
All right.
Yes.
Rubber hits the road.
And I love this next slide, which is showing, it's a table and a chart showing the migration from net migration from each state last year. I'm only showing the top 5 and bottom 5. So what you can basically see is on the table on the left is that you had states like Florida and Texas and the Carolinas see a net migration. So they saw an increase in the number of people that were living in their state. Texas added almost 231,000 new residents, and you had states like New York and California losing a lot of residents. And so that's something that had kind of started a couple of years ago in the second half of 2020, continued in 21, and we saw that same pattern emerge again, still pretty strong in 2022. So for Texas, I mean, the point that I would take away is that we have more demand for housing because we have more people moving here on a net basis.
Mm-hmm.
And so again, another sort of indicator for the Texas and Houston areas of, you know, sustained home prices and not seeing home prices fall down because you have more people that need to have a house. And so, anecdotally, I mean, I think we're still seeing people move from other states moving into Texas, at least in our own branch.
Certainly.
Yeah. What I see here is we would have been number 1 in beating Florida's booty if we'd had better beaches. If we'd have Florida's beaches, we would have been number 1. So definitely the best place to live and do life.
So maybe something we'll suggest that to Governor Abbott.
Yeah, fix our beaches. We'll be Florida next year.
Indeed. So I just thought that was an interesting piece of data. Mm-hmm. And this next slide goes along with that and is basically showing a forecast, 2 scenarios, a forecast for the Houston area metro population. And in the let's say the upper case scenario, we add 1 million people over the next decade to the Houston area alone. Mm-hmm. In the lower case scenario, we add almost 750,000. So Houston area over the long term expected to see a population increase, which is of course good for housing demand.
Home values going up.
Good for housing demand and bad for you if you're trying to compete for that house.
That's right.
You know, it's like how, again, all of this is just further showing what we've been saying, that home prices are going to continue to rise in the Houston area almost irregardless of what's going on nationally. I mean, it's like almost as the country gets, you know, worse in certain areas, that just drives more people to Texas, you know. And so this is something that, you know, I remember looking at a couple of years ago and thinking, man, you know, there's a lot going on from an economic standpoint, from a political landscape. Regardless of what you think, it's creating a magnet that is pulling people to Texas right now, just like Florida's creating a magnet. And so you can agree or disagree with why those things are happening. The reality is they're happening. And so from a housing standpoint, which is what we do, we got to look at that and go, okay, we're going to be in a tight space for homes for a long time.
Yep, that's absolutely the case. Moving on to the next slide, this is sort of looking at economics that are specifically relevant to Houston. On the left, I'm showing the oil and gas unemployment rate that actually came down in January. So meaning that the unemployment rate is even lower, meaning the employment's even higher. So again, still really strong oil and gas labor market here in Houston. And then data on the right-hand chart is just showing total Houston employment. We're still seeing that remain elevated. We saw a little bit of a drop in November, but that jumped back up in December of 2022, which is the latest data I have available. So,
yeah, and the big thing here to remember if you're a realtor or buyer is like things might be happening nationally, like unemployment might be going up, even though we share the jobs numbers up. But if unemployment nationally goes up, but unemployment here in Houston is not, then things are still going to be strong here. And so don't look at the national news that, oh, this is happening. It's like you're buying real estate in Houston, you need to know what's going on in Houston.
Right.
Right now, oil is booming, healthcare is booming, and very few people are unemployed in Houston.
That's right.
And lots of people are gainfully employed.
Yeah, I mean, we talk about how real estate is obviously so local. And
this is why.
It's local, it's regional, right? We talked about the region just a second ago. Of course, it's impacted by things nationally. But at the end of the day, some areas of the country benefit opposite of what's happening in the rest of the country. So.
Right. Yeah, and I mean, on the next slide, we're seeing a sort of continuation of that theme, talking about all of Houston's unemployment rate almost back down to pre-COVID levels. So we're still continuing to see that come down. So that's what the chart on the left is showing, is that unemployment rate for Houston. And then on the top right, I'm showing Houston area real wages, so wages that have been adjusted for inflation. And again, we're seeing that kind of move back up. The latest data that I have is from Q2 2022, so it's a little bit delayed. But again, there was no reason to think that wages have come down substantially over the past, let's just say, 6 months.
When will we get the Q3 data?
It's delayed, so I think we get it in March.
Okay.
Yeah, so it's pretty delayed, unfortunately.
Yeah.
For the table on the bottom, this is showing Houston area bank deposits. So in 2022, checking savings account, so liquid assets available to Houstonians was at a record level. And that just goes to the point that we were making earlier that, let's say people start to lose jobs. They still have liquid reserves and they still have strong property values. So good indication that we're not going to see property prices fall off a cliff here anytime soon.
Yeah, we need to be seeing those things moving in the opposite directions of what we're seeing, right?
Right. And then just on this next slide, this is something that we showed on the last episode, but wanted to bring it back just to show that the trend is continuing. So here on the slide on display, I'm showing the S&P 500 index, which is in the blue, versus Houston area large employers that are publicly traded in the green. So that's going to be people like HP, Exxon, Chevron, etc. And those publicly traded employers that are big employers in Houston are outperforming the wider market, which is a great sign. Again, for those people that are living in Houston.
Hey, Houston is putting it to the S&P, baby.
That's right. Yeah.
So this is not financial advice. This is just we're just looking at this.
Yeah, we're just looking at the data.
Stock price is important because it means the market believes in the companies in Houston, and the companies in Houston are running their books well. They're reinvesting money. They're deploying capital. They're hiring people. They're paying bonuses. Like stock price is indicative of a lot of healthy behaviors you want to see in employers operating a business, especially in Houston.
Yep.
It's a good place to be.
Yep. And then for wrapping up this section before we move to the last one, just a couple of things that I want to highlight. The table on the top left, it's just showing the impact from previous U.S. recessions. One thing that Jonathan has pointed out is that people worry in a recession what's going to happen to home prices. Over the last 6 recessions in the U.S., 4 of the last 6, we saw home prices increase during the recessionary period.
Yeah, baby.
Yeah.
Obviously, a lot of us remember the 2008-2009 financial crisis, which was driven by real estate.
Right.
So that's what's in our mind, but a lot of times during recessions, home prices don't actually fall. And then a group of local economists that call themselves a Greater Houston Partnership, they do a forecast for Houston, and in their worst case scenario, Houston is actually adding jobs in 2023. Which, if you look at the table on the top hand left, during recessions, typically we lose jobs. But at least, even though most economists are expecting a recession over the next 12 to 24 months, Houston's expected to increase in its total number of jobs. So Houston remaining strong, even if, like Jonathan was saying, other parts of the country see recession, we might not be experiencing that in the same way.
Yeah. Absolutely.
And these are jobs that the Greater Houston Partnership thinks we're going to add. I have clients that are calling me, I don't have a job yet, but I want to move to Houston, you know? And a lot of times we can help them buy a second home or an investment property, or maybe they have income that doesn't really change, you know, based on where they move. They could keep their income, you know, not to go into different types of income. You know, got alimony, child support, VA, disability. There's a lot of income, distribution income. Like there's a lot of types of income we can use that does not matter whether you move around or not. And this is jobs being added. Right. And so on top of that, we have all these other people coming here.
Yep, absolutely.
So things could be really good this year from a job standpoint.
Yeah.
Cool. All right, well, that wraps up that segment looking at the economics specifically related to Houston. And now we're going to move on to the next one, which is Houston area real estate update.
Let's go. HTX.
Okay, so we did mention earlier that we would share some data with you from our own branch. And
we're getting personal.
We're getting personal. So we're putting our cards out for everybody to see. So right here we have on display right on this current slide, we have the Bunk and Baker loan applications since 2021, and we have it broken down by month. So you can see each year's monthly applications. So, the first thing I guess to point out is that we did see, so you see in the dark blue bars that's 2022. So our application volume did fall, especially after June time period. We saw a pretty substantial decrease. And that goes along with what we were seeing earlier when we saw application volumes nationally fall as we saw interest rates increase. So
rates crossed 6%. Went.
Yeah. And really, once they started rising, applications across the board started dropping. We didn't feel that. The Houston market was just ragingly hot, and we had applications just pumping first quarter of last year, even into April. And it wasn't until May where we felt that let off. And so I think this is all, we all knew this. If you're a realtor in Houston, this feels like your year last year, where the spring, early part of Q2 was just crazy hot, and then all of a sudden we got to the summer and it was like, where'd everybody go? Interest rates launched. But what I like about this chart here, Hugh, is how we see the trend back up. So if you go to the end of the chart, you see, okay, every year apps are down at the fourth quarter, and then they pop back up in Q1. And so for me, this is something I personally like to look at, is how much of a pop are we getting? And we can see that there's been a 73% increase in January's applications from December. I think we're actually missing a couple of applications in that number. I think it was actually closer to 80% when we get all that in over last December's applications. That's a significant bump in applications. Obviously, we're still down 20 to 30% from where we were last year. But look, we're beating 2021.
Yeah.
And 2021 was a great year. And so I think the data, we've been talking about how 2023 is going to be more of like a stabilizing year. Some people think it's going to be almost like an inversion of last year. I don't know about that, but I think it's going to feel pretty normal. And right now we can see like, dang, it's beating 2021. There's a lot to be excited about seeing that.
Yeah, absolutely. The only thing I would note is that February data is forecast. So we took everything that we have month to date, but we are prorating the rest of the month, having a little bit of a forecast. But based on what we've seen this month, we're expecting that this month will be better than February 2021, which I think is pretty amazing given that we're 6.5–7% interest rates right now. February 21, you're probably around 3%.
And I mean, we're ahead of January, right? You can see in 2022, actually January to February slumped a little bit. Right now, even though it's a shorter month, we're projecting we're going to do more applications in February than we did in January, and interest rates have risen in February from January. So that's also an added indicator.
And I mean, I guess from the realtor's perspective, the applications that we're seeing, in January, February are going to be the houses that are going to be closing in March, April, and May. So as from a real estate perspective, we think that this is a good leading indicator saying like, hey, things have not fallen off a cliff. Things are still happening, and there's reasons to be positive.
If I'm a realtor, that says active buyers. And so back to inventory, and I know you're about to show an inventory slide. It's like if you have little inventory and more active buyers come in the market, what do you think is going to happen?
Prices multiple offers.
Home values are going to stay where they are.
I'm seeing things, whether it's in the Heights or Brad Grove Park, like all across town, these hot areas. Sellers are getting smart. They're not trying to list for what they think they can sell it for. They're listing it below, trying to create these insane bidding wars. And I've got people leading right now, putting in almost $100,000 over what the house is being listed for. Like first out of the gate, it's because they just know it's
if you're a buyer,
bloody.
It's slim pickings right now. There's just not that many great houses on the market, that check all your boxes, that fit your price point, that it's part of town. And there's a lot of active buyers, and there's just not much inventory.
Yeah. So just following up on that point, here's our inventory slide on the next slide. So the chart on the left, I'm showing 2019 versus 2022, and I'm showing 2019 because 2019 is a more normal year. 2020, 2021 were a little bit abnormal. So what the lines show is just sales versus listings. So if you have for every sale a listing, only one listing, then you would be a 1-to-1. So your line would always be up to 1. That means that you have no inventory, meaning that for every sale there's only one house that's becoming available to sell. And then basically you can see on the picture on the right, I'm showing the inventory from HAR from last week, showing that we have 2.2 months of inventory. And you need about 6 months of housing inventory to be in a neutral market.
Right.
So I estimate that you would have to fall, around 30% on a sales to listing ratio to get to that neutral inventory level, which is just saying that we would need to see a massive increase in the number of houses that come on the market in order to just even get to a neutral level.
Or a massive decrease in the number of people that are needing to and trying to buy right now.
Yeah, and with people moving here and jobs strong, that's probably not going to drop off.
Yeah, and this is all of this really is for you as realtors if you're watching. This is the ammo behind the case for why people need to buy right now with interest rates being where they're at. Home prices are not coming down, and interest rates will come down. They will come down. You will have an opportunity to be able to refinance. And if they don't, goodness, don't you want to buy right now if they don't come back down? So in my mind, from an interest rate standpoint, somebody's sitting on the sidelines going, oh man, interest rates are too high. I'm going to wait to buy. To me, that is a fool's errand. Right. It's like buy now because home prices, they're only going up. And if interest rates keep going up, you'll be glad you bought now. And if they come back down, you refinance. It's really you've got nothing to lose by financing something right now, but you do have a lot to lose, in my opinion, by waiting to buy right now. These houses
especially if you're renting.
Right. Yeah.
Oh my God, yeah, if you're renting.
Yeah, so I mean, last month it was like 2.8, or
Yeah.
December was 2.8. Now inventory is 2.2. And one of the things I leave you with as a realtor, we're always reading the news, but I heard somebody put the spring and probably the summer, like 2022, the first part of the market. How would you describe it? And I heard calm and competitive. And I think I like that because calm to me is like, you're not going to, if you're used to closing 10 houses a month as a buyer's agent, you might be closing 4 or 5, like we're all feeling it. We're not closing as many loans. It's a calmer market. There's not so many transactions, but the transactions that are happening are, like Austin said, they're very competitive. There's a lot of multiple offers. And so I think we're going to see a calm and competitive market until we see rates get back below 6%. And I thought that was going to happen sooner, but based on everything we shared earlier in this podcast,
it looks like we're higher rates for longer.
Might be a while before we get to 6%. It might be the end of the summer. It might be the beginning of the fall before we get to 6%. So from now till then, it's going to be a very calm but competitive market, which means you need to be working with a pro. If you're a buyer out there, you need to have a great realtor behind you. You need to have a great local lender behind you because things are competitive.
Yep. That was a great summary. We just need to cut that and bundle that and give that to you guys.
I'm trying to give it to the people.
Yeah. So that was great. I can't sum it up better than that.
Yeah. So should we even try?
Nope.
But go for it.
All right, but I'll try. So just a summary. Basically what Jonathan was saying. Inflation seems to have peaked. It might be higher for longer than we were anticipating at the beginning of January, but we do think that it's going to be coming down. That'll give the Fed some space to ease their interest rate hikes that we've been seeing. Houston, it's a growing population, forecasted to continue growing. Inventory is low, so we think that that's going to help sustain home prices, in addition to there being high levels of bank checkings and savings accounts, strong wages in the Houston area, strong labor market. And then, like we've said, half a dozen times, Houston inventory for housing is low, and we're not expecting it to change really dramatically over this year. And so while that might make it tough to buy a house, it also is going to help support home prices from falling. So
yeah.
And then the last thing, and we talked about this, is even in the worst case scenario, Houston's supposed to add 30,000 jobs this year. So really good indicator there.
My final thoughts on the segment is, one, interest rates are national, but real estate is local.
Woo, preach, bro.
Right?
I like that.
So interest rates, we got to pay attention to what's going on nationally, because that's driving that piece of it. That does impact the local real estate market to an extent. But ultimately, real estate is local, and so we got to be paying attention to both of those factors. And our outlook is that, hey, we can see that the trends, like things are starting to level off, but there are still some pieces of it, whether it's labor or what, that's still way too hot. That's got to calm down before we start to see the Fed start to ease up on things. And until that happens, interest rates really aren't going to start coming down. Right. But they will, and we can see that we're starting to get there. But it's like Jonathan said, we might not see lower interest rates until Q3. We were thinking maybe Q2.
We were hopeful in April.
April, maybe we'd see some better stuff. And it might start to get a little bit better, but I think we're going to be it's going to be a slow road down as far as rates go, in my personal opinion. My prediction is, I think 30 days from now, we're in a fairly similar spot interest rate wise to where we are right now. Right.
Yeah.
Y'all agree?
I agree.
Yeah. So that's our thoughts for this episode of Hugh Knows. Hopefully some of that is helpful to you guys. Ultimately, we're all in this together. We're trying to help everybody get home, finance their homes. We're trying to help you guys as a real estate community have the ammunition you need to be informed as you're talking to your clients. And so if you've got any comments, questions, or suggestions, put them down below. We'd love to hear from you. Otherwise, we'll see you next time.
Adios.